95% of the market is SMEs. Before you offer credit to a company, how can you assess that company's creditworthiness? The confidentiality card is not necessarily having any economic backing to it, but corporates who offer open credit to their customers often don't have sufficient data. I think India, from a digital space, is at least 15 years ahead of many other markets out there in the world. And if you notice it, there is no professional qualification for credit management. Credit insurance is a fantastic tool, in my opinion.
Hello and welcome back to Trade of Thought. I am your host Akanksha Anil, and today we are going to discuss something that has been plaguing most businesses, and there is not a lot of information about it. So, to get more information about it, we've brought in an expert. We are thrilled to have Faraz Ashraf with us on this podcast today. Faraz is a distinguished fellow of the Chartered Institute of Credit Management, UK, bringing a wealth of expertise in credit management. As the co-founder of TREVEX, he is at the forefront of innovation, working to digitalize the traditionally manual process of B2B credit management. So let us start with your journey up until TREVEX. Can you tell us why did you choose this field specifically?
Okay, cool. So, quick background. I am homegrown in Dubai. Basically, I'm born and raised here. So, entire my education, high school, university, both bachelor's and master's have been in here. So, during my bachelor's, I did work during the daytime and did my college in the evening. So there was not a lot of options that you could select in terms of what career choices you wanted to go to. So I used to work for Emirates at the time in flight operations. And it was quite a challenge when you have shift timings and a college to go to exam studies was hectic. So I decided to take a leap of faith and I quit Emirates. And one of my classmates at the time was working for a company an outsourced zone that did field verifications for banks. This is where individuals who's applied for credit cards or loans, or even corporates who's applied for credit cards or loans, this is the company that sends out agents to sort of do employee verification in the offices. So I stumbled an employment offer there. I started from there. From there, I moved on. The natural growth was to go to a bigger corporate in the same line of work. So I ended up in Dun & Bradstreet. That's where my whole career in credit management started. So this was, I think, if I remember correctly, 2014 is when I started my proper, if you can call it, credit management, B2B specific. From a credit rating perspective, I've done it from a bank's perspective. I have been a B2B consultant that goes into companies and helps them, fix their credit management policies. I've also worked as a credit controller for a corporate here. So I've basically seen it from every different possible angle that you can think about. And one of the key problems that we often come up with is before you offer credit to a company, how can you assess that company's creditworthiness? As a non-banking corporate. So banks, FIs, they all have access to certain tools provided by the central bank and other sources. But corporates who offer open credit to their customers often don't have sufficient data or any sort of access to platforms or directories where they can go and check the creditworthiness of the customers, and they often have to sort of wing it, if you'd like to call it, in giving credit and hoping that it will turn out to be a good paying customer. So to address that problem is how I met my now co-founder, who's an ex-CEO of a trade credit insurance company. He had the same problem underwriting buyers that had to get insurance. And we did a few ping pong sessions in terms of what the problem is, what's the root cause of the problem, and then decided to put up TREVEX, which is the company that I'm with right now, that addresses the problem directly in terms of how can you access information on businesses, particularly SMEs. Public companies is very easy to get information on. Particularly SMEs, how can you get the right information, qualified information, and from the correct source in order to truly assess the creditworthiness of those businesses.
So you mentioned that you've been in this industry since 2014 and you've seen the various facets of it. So how do you think has credit management evolved when it comes to B2B businesses, and what notable trends do you foresee for 2025?
Okay, so one of the things that I usually preface when I do either interviews, podcasts, or even public talks is the fact that anything I talk about credit management is a very personal, subjective opinion of mine. So different people see it differently.
Yeah.
So, and before I get into what the trends are and what have been the challenges or how it's evolved, the one thing that I'd like to preface by start is credit in itself, the word, comes from Latin word that means trust.
Good.
Right? Let's establish that. Now, there's a big misconception in the market that credit is supposed to be a function of finance. Right? The 9 out of 10 times when you ask somebody that which vertical should it fall under, they'd say under finance.
Yeah.
I have a different opinion. I think while it is a hybrid model between sales and finance, in my opinion, it's actually tail-ended towards sales more than finance. And we'll sort of see that in the coming minutes. Now, how has it evolved? So, like I said, in this particular market, credit is very subjective in how people have assessed businesses.
Yeah.
If you look at UK, developed markets like Europe, India as well, the access to information, the access to data from central authorities for businesses itself to assess their customers is readily available.
Correct.
Right?
Correct.
That's not the case here. So it is nuanced even regionally.
Correct.
Inside a region, it's also subjective on an industry level. Inside an industry, it's also subjective on the scale and size of companies.
Correct.
If you are a multinational company, you've got much more authority. If you are a monopolistic business in an industry, you can basically demand certain things from your customers.
Correct.
And otherwise, right? So in this particular market, what's happened is we're not as digitally savvy when it comes to credit management as other markets, right? We're getting there.
Yeah.
Especially UAE and Saudi has a lot of ambition to sort of digitize a lot of business information about SMEs, which can be accessible, which will basically be a game changer. What's happened in this market is pre-2008, as everyone knows, most of the things that businesses touched on gold, right? So if somebody made a promise that they would make payments in 30, 60 or 90 days, often it happened in 30, 60 or 90 days, if not earlier, right? So credit as a function was not something that people thought had importance because there was no need to manage it because it was sort of self-fulfilling. Post the crisis, what's happened is because of the cash crunch, everyone now started looking at the finance function, the credit team, asking what can we do to sort of improve the cash flow of the company. Now, because there's no particular qualification for credit management as a function, often finance managers, finance directors has taken lead in terms of deciding how to manage credit.
Correct.
Now, from a custodian perspective, which finance people are, when you look at making sure that you save your money and you hold the money in, if you apply that in credit, often what happens is it affects your sales team and it affects your revenue top line because you choose not to sell to anybody out of fear that you won't get payments on time. Now, this stretched on until 2015, 2014, 2015 when the oil crisis happened. So when the oil crisis happened, regionally, budgets just fell. Right? So active projects were on hold. Right? We had a big cash crunch during that time. Now, this is the time when everybody raised their hands and said, we've got to do something about this. Right? Now, this is when a lot of aggregator platforms, a lot of credit rating companies stepped in and said, you know what, we can try and get information on businesses, we can try and trace payments, etc., how people are doing it in UK, how people are in Europe. But unfortunately, in a market where data is held back from businesses and not shared with aggregators, aggregators can't come up with solutions to help businesses decide which companies are good, bad, or ugly. Now, in the process, what's happened is a lot of businesses started looking at trade finance as a function, right? If no one's going to give us credit, let us go and get credit from a bank or an FI, or a non-banking financial institution. Now, banks have the same issue, right? They also look at the SME segment to a great extent as high risk. But for good reason, banks sort of played very safe with SMEs and are very selective, which, if you look at this country, 95% of the market are classified as SMEs. So, in my opinion, when you ask me if there has been any evolution as such, I would personally have to say that not necessarily in the right direction, right? But things have sort of changed and people have adapted to what's available.
Correct.
Is it right or is it wrong? I'll leave it for everyone else to decide. But and in terms of are there any particular trends globally? There are a lot of great trends out there. I just attended a credit management conference in which there was a company out of Paris who had built a platform called My DSO Manager, which allows businesses to directly plug their SAP into the software, which pulls all the receivables, manages follow-ups automatically, AI-based, sends out payment due dates, and sends out collection requests, dunning letters, and a whole bunch of them, which I think is great. But again, it works really well in markets like Europe. Over here, if there is a sort of a cultural trend in which people hold back information. And I'll give you an example of what I mean by people hold back information. So we were doing a report on a company based out of Dubai, not an SME in any shape or form. We're talking about post-M closing towards MNC level. And my team comes up to me and says, Faraz, they've shared some information. They've given us a trade license, but they're not telling us who the shareholders of the business is. And bear in mind, this is a company that's applied for $250,000 worth of credit from a supplier. And supplier is doing a basic due diligence on the company.
Correct.
So I said, fair enough. So I called up who was the finance director at the time, very educated gentleman. And out of curiosity, I asked, I was like, any particular reason why you wouldn't want to share your shareholders' information? And he said that, no, Faraz, that's confidential. We can't share that. So then I asked the question, is there any particular reason why you think shareholders' information is confidential? He said, no, it's company policy. I said, fair enough. My next question was, you're based in Dubai. In Dubai, trade license, there are 3 pages. The first page is the license information. Second page is the shareholders' information. Third page is not necessary, right? Because you're a company based in Dubai, you have the luxury of holding back the second page. You can give the first page as KYC. If you are a company that's based in Abu Dhabi, which is the capital of the country,
correct,
you don't have that luxury because in Abu Dhabi, license is 1 page and your shareholders' information is available there itself. So my question to this gentleman was, if you ever decide to go to Abu Dhabi, or if you are in Abu Dhabi right now, you don't have the same luxury. So at that time, do you not even share the trade license information when people ask for KYC? And I had a silence for about 10-15 seconds. And then the response was, Faraz, you know how it is. Right? So it's not necessarily, the confidentiality card is not necessarily having any economic backing to it from a business standpoint. It's more to do with the mindset that a lot of businesses have had here. But I have to admit, there are a lot of companies out there today who has evolved from that mindset and has started to become a lot more transparent, realizing that credit is only accessible when you are transparent as a business.
Correct.
Right? So yeah, in terms of trends, I think primarily it's going to be SMEs realizing that we can't play the confidentiality card if we want to get access to good quality credit, and finding ways to become more transparent with their counterparts.
That is very, very interesting when it comes to transparency. And you would expect, like in an industry where we're talking about credit and trust, like, when you think of it, it boils down to trust at the end of the day, and people are like hiding and still being mysterious about it. So how do you think they can better establish this collaboration when it comes to finance and sales, like both the teams, for them to collaborate to optimize the credit management and to do it more efficiently, which will then overall enhance the financial performance of that company?
Very valid question. So in my time as a credit consultant, when I used to go into businesses and try to understand what is the root cause of why the cash flow issues are there, one of the key things that I used to do was talk to people, right, in the company and ask them what do they think the problem is, right? And believe it or not, most of the time you can fix it if you just listen to your employees, because they just know what the problem is and they know how to solve it. So when I speak to the finance team, one of the biggest concerns the finance team has is our KPI is cash flow. When we are given requests from the commercial team of new customers that they want to give credit to, or existing customers who's asking for more credit, if we believe that the customer is not credit worthy, right, we have to say it. But when we do say it, in the interest of top line generation, companies often overturn that decision and come back round circle when it comes time to check KPIs of individuals and the company as a whole. When cash flow is affected, it becomes a problem.
Correct.
Now, when I speak to the sales team, what I get is, see, my task is to create top line. I'm bringing in companies, businesses, established or not. There are businesses who are coming who wants to work with us.
Correct.
In this market, without credit, nothing functions. Right? You can't expect to have cash in advance unless and until you've got a great monopoly in that industry. Right? So salespeople complain that the finance team is not approving credit quick enough. So we're losing customers. They're asking for too much information from customers. We're assessing them, so we're losing customers to competition.
Yeah.
Right? This is a very common thing that happens. Now, I think there are 2 or 3 ways in which you can fix this. And I've seen this happen in companies that I've worked in, as well as the companies that I've gone to help out. The first thing, the most important thing, in my opinion, is you, as a company, the shareholder of the company, or the shareholders of the company, or the UBO of the company needs to decide what's important. Is it top line, which has no reality check in the bottom line? Or is it an overall financial health of the business? And once that's decided, I think it's important to translate that to the business teams across the board, both sales and finance, that our aim and our KPI and our expectation from the business is X, Y, and Z.
Correct.
This needs to go on what I call is the Bible of every company, is credit policy. Right? Because if your credit policy does not define this properly, your sales team and your finance team is going to always be in doubt what's more important.
Yeah.
Making sure we hold on to what cash we already have and make sure we only take good business, or can we take a little extra risk and increase our top line?
Yeah.
Once this has been established in the credit policy, which is what I call having shared goals and objectives,
Correct.
right, for both the teams together. The next thing what I would recommend very highly, is to have an incentive program which is integrated between both sales and finance. So what I mean by this is, it's not necessarily only an incentive structure for revenue generation. You also have to look at profitability of the revenue generated, cash flow, collection metrics.
Correct.
Right? This, what happens in this particular case is when sales team go out to sell, they know what the company's risk appetite already is. Right? They know that they can't go ahead and pick any customer.
Yeah.
They need to make sure that they also get selected with good quality customers,
Correct.
which will then reflect in the profitability of the business. Lastly, what I would very highly recommend is to have cross-functional training sessions. Right? So one of the things what we did in the past was we had a training session done for a very large equipment supplier for the construction sector in the country. Instead of doing the credit management function as a training workshop for just the finance team, we did it finance and sales together. So it was a 40 people workshop together. Most of the sales individuals didn't even know what was the cost of bad credit. Right? You often tend to look at how much revenue you have to create, but they didn't realize how much the company gets affected when one company as a customer has defaulted on a payment, and that turns into bad debt.
Correct.
So when the sales team was made aware of what the cost of credit is and what credit in itself is, and how it's important for them to make sure that even before it goes to the finance team, they have to do some sort of pre-selection of these customers, because often people don't realize that finance is not the front line of a company. Sales is the front line.
Correct.
Right? So when sales team is out there, they have knowledge that even the finance team can't get access to.
Correct.
They talk to people, they network around. So by look, to a great extent, a salesperson can tell if the company is good, bad, or ugly. Right? So to a great extent, assessing the credit risk of a new customer needs to be a shared objective between sales and finance.
Yeah.
It should not just be on the finance team's head.
Correct.
So that in the future, if anything goes wrong, right, it's not saying that, oh, the finance team is the one who approved the credit. Right? As a sales function, you also have that responsibility, and you have to be accountable for what happens to your customers. In my opinion, credit as a function needs to be tail-ended towards sales, right?
Yeah.
Which sort of what I would call a dotted line function to finance. So that the commercial team in itself, while generating revenue, is fully aware of the potential credit risk that their portfolio has.
It's so interesting how together collaborating can not only prevent bad debts, but can also improve functionalities across teams. So we spoke about bad debt. Now I want to know what challenges and opportunities do businesses face when it comes to managing credit, and how can they navigate this effectively?
Cool. Good question. Okay. So, two perspectives, from a supplier's perspective, which is the seller, and from a buyer's perspective, which is the customer. Right? Now, from a supplier's perspective, one of the biggest challenges in this market in managing credit is not knowing who your customer truly is. Right? Now, unfortunately, for corporates in this part of the world, there is not a lot of databases or resources available for them to assess customers beforehand of giving credit, right? So, in a simple example, if today there's a sales team that's procured 10 new customers, before giving credit to these 10 new customers, you have to assess them. A simple KYC.
Yeah.
You can either do it by yourself, right, by asking them whatever you want, or you can go to external parties to get information on them. Both of the ways aren't very different because no one company has a very special method of obtaining this information. It's still a phone call with the company, it's still an email to the company, and they can tell you what information they want you to hear.
Yeah.
Right? So this needs to change. This is one of the biggest challenges, and this has to change because in every other developed market, so if you take UK for example, it's sort of a gold standard. There's something called Companies House, which is an online website which is put together by the government of UK. You don't have to log in, sign up, anything. You just search for any registered company in the UK, starting from the time of inception, leading up to date. Every single filing, financials, shareholder changes, trade license, certificate of incorporation, it's accessible for you to download, do what you want with it.
Wow.
Right. Same thing applies to India as well. In India, information on private companies is sort of there are plenty of aggregators. We've got quickcompany.in, you've got instafinancials.com, and its APIs left, right, and center. I think India, from a digital space, is at least 15 years ahead of many other markets out there in the world.
Yeah.
Right? This makes it easy for you to sort of assess who you're working with.
Correct.
Are they good? Are they bad? Or are they ugly? Right? And you can take the right. I'm not saying you should not work with companies you think are having problems, but if you really want to work with them, factor that into your pricing as well.
Correct.
Right?
Correct.
It's your risk appetite, right? It's up to you whether you want to work with risky customers. It's fine. There's no problem with that. But in this part of the world, you don't have that luxury. It's happening. There are initiatives in place from regulatory bodies, both in UAE and Saudi, very actively to sort of come up with a more centralized platform that can help corporates also take quality credit decisions.
Yeah.
Right? But today it's not there. And I think that is a challenge to which an opportunity is just on the horizon. It's not out there yet. From a buyer's perspective or from a customer's perspective, in terms of managing credit, I think the most difficult thing for them to solve is the perception if you are an SME.
Yeah.
Right? There are extremely good quality businesses out here who are very true to what they do, who've maintained quality books of accounts, who's willing to be as transparent as possible. But over time, what's happened is there is this certain, what I call is biased lens on SMEs, considering them as a blanket high-risk category.
Yeah.
Right? And this affects the ability of some of the good SMEs to get access to good quality credit for a reasonable price. Right? There are banks and FIs and corporates willing to give credit to SMEs, but because they treat all of them as high risk, the good companies pay the price.
Yeah.
Right? And I think that is the part which has to change. There is a big disparity in the amount of financial loans that go out from banks, FIs to SMEs in this market. There's a published report from the Central Bank of UAE itself, which says 10% of the total accumulated loans from banks goes to SMEs. Going back to what I said earlier, 95% of the market is SMEs. So there is a big disparity. Rightly so, where banks are unable to give maximum support to SMEs. And I think it will change. And it will change mainly when SMEs come to terms with the fact that being transparent as a business is what's going to get you the credit that you deserve.
Yeah. Yeah. So with SMEs, I see that there is a lot of, problems and biases against them. And now that we have gone into SMEs, I want to understand if there are any industry specific nuances or on B2B credit management that businesses should be aware of and how they can sort of navigate that.
Oh, 100%. I think every industry, every sector in every industry, every size and scale in that sector, there are nuances. My concern in this market is a lot of businesses, specialized sectors, right? While they have already acknowledged that there's a problem with the credit function, tends to try and solve it themselves without seeking help. Right? You need to go to specialists who can come in, understand your business end to end, and tell you what is best for you.
What do you think is stopping them from asking for that help?
I think one of the biggest things in this, the hindrance is, in my opinion, is it applies to our daily lives as well, right? A lot of people stay away from asking for help because it makes them look weak, right? So a lot of big corporates, a lot of even SMEs for that matter, right? They don't want to be looked at as someone who can't manage their cash flow. Now apply this on an individual level inside the company. Which finance director, finance manager, or credit manager would want to own up to the fact that there is a functional issue and we need help from outside? Wouldn't they be questioned, why didn't you solve this in the first place? But there are companies who actively seek help as well, right? And I think, in my opinion, they are the ones who actually thrive. Because once there is help from a specialized individual or a team of individuals, there are KPIs in place, there are monitoring tools in place, right? You can clearly see what was the difference from pre-workshop to post-workshop. And I think that has to be the number one way of companies addressing industry nuances is when a credit manager goes from one industry to the other industry, there is an understanding that I know what I'm doing. Right? Doesn't apply.
Because it's a whole new industry.
It's a whole new sector. Relationships with customers matter. Huge variable in the equation. Your ability to negotiate with the customer matters. Are you a monopolistic company in that industry, or are you somebody who's facing endless competition? Right? Logistics is a perfect example for that. In freight forwarding, there's a concept called credit shopping, which is customers who would go and seek credit from one freight forwarder, exhaust the credit there, delay payments, they'll suspend the account, they'll go to the next freight forwarder. And there's no centralized database for people to realize who's defaulting where. And because it's a very competitive industry, people tend to take up more accounts.
And industry also, they're not exchanging information as openly.
Absolutely
so
not.
Why would they know?
Exactly. I think that's another thing as well which lacks, which again, I keep going back to UK. UK has got something called a trade payments program. Right? This is where companies within industries share their receivables files with aggregator platforms, who then assesses which businesses are actually paying on time and not, makes that information publicly available. The government uses that information to penalize companies who delay payments, gives them a period of 6 to 9 months to get their act together, and then remove them from the blacklist.
Wow.
Right? So that's a much more forward developed way of looking at how credit works, as a function. But I think we're on track. I think in no time we sort of will be there as well.
So now that we are looking ahead and looking at what can come and what things can change, and so what do you think is a key advice that you would want to offer B2B businesses in terms of credit management?
Perfect. I think if you are a supplier or if you are a seller, and if you are seeking to offer credit as a sort of an incentive to your customers, treat credit for what it truly is supposed to be. You've got to build trust first before you start giving them, the benefits of trust. So as much as possible, try to get some traction with the customer first without credit or with very limited credit. Right? Build a relationship with them. That makes a big difference because you can start understanding the people who are on the other side of the table as well. Right? A lot of times it has to do with the ability of the people on the other side to process payments on time. And if everybody does that, then buyers don't get the leverage of demanding credit from the very start itself.
Correct.
Right? It's because of the very high level of competition when sellers tend to use credit as a method of sale. Right? That happens in this market. That's when it gets, a little icky in the process. That's my advice to sellers: is make sure that you gain trust first before you offer the credit as much as possible. Not saying that you have to demand cash or say no to the business, but give restricted credit terms. Right? You can use external methods such as trade credit insurance, right, to sort of find a way to protect your receivables in the event of default. Right? Trade credit insurance is a fantastic tool in my opinion because they have data that many people don't have, which is who's defaulting in the market.
Yeah.
Right. So if an insurer tells you that we don't want to give credit to this buyer of yours, take that advice for what it is.
True.
Because they know what they're doing. Right. That's from a seller's perspective. From a buyer's perspective, I think I'm going to hold that mantra true, which is learn how to be transparent as a business if you want access to the credit that you are asking for. If you are a business that goes to secure $100,000 worth of loan from a bank, when the bank asks you 100 questions, you give them 120 answers. But the same $100,000 as a customer, if you go and ask for credit from a supplier in the form of in the monetary equivalent of goods, when they have to give you that credit, when they ask you 100 questions, you tend to give them 20. Both are supposed to be the same.
Correct.
The monetary value is the same, right? So I think there has to be a change in the way SMEs think, businesses think, where transparency is going to be the biggest key to accessing good quality credit in the market. And when everybody starts doing it, that lens of SME being high risk starts to fade off, which is when they start getting access to credit at a much better cost than they are paying today.
That is very, very interesting. And with this, we are at the end of our questions. Thank you so much for being a part of the podcast.
You're very welcome. Thanks for having me.
So that was an end of an informational video. If you enjoyed this episode, don't forget to like and subscribe and hit the bell icon so that you are notified every time we put out a new video. That's it from me, your host Akanksha Anil, and I'll see you on the next episode. Bye.